Have you heard of Fibonacci retracement? Every trader worth their salt talks about it, from YouTube educators to overseas trading communities. So you gave it a shot, and it didn't work. Same tool, completely different results. There's one reason for that. You've been drawing it in the wrong place. In today's video, we'll walk through how to set up Fibonacci correctly, then cover 3 practical trading strategies you can start using right away. By the end, you'll know exactly why it hasn't been working and how to fix it. Before we dive in, let's go over 2 mistakes most beginner traders keep making. The first mistake is drawing Fibonacci without confirming the trend. Fibonacci retracement is a tool for measuring pullbacks within a trend. If you draw it anywhere without first identifying whether you're in an uptrend or downtrend, the signals you get will be meaningless. The second mistake is entering the moment price touches a single level. A lot of traders jump in the second price hits 0.618. Fibonacci levels aren't lines, they're zones. The key is to wait for price to enter the zone between 0.5 and 0.618, the golden zone, and then confirm how the candle reacts before entering. Fix just these 2 mistakes, and your win rate will start to change. Fibonacci Basic Setup. We'll be using TradingView for this walkthrough. Select the Fibonacci Retracement tool from the left toolbar. Click on the chart and drag to draw it. In the settings, keep only 3 levels: 0.382, 0.5, and 0.618, and uncheck everything else. Lower the background opacity as much as possible to keep your chart clean, and set the label position to right middle for easy reading. That's all for the setup. Let's keep it simple. Now let's quickly cover why Fibonacci works so well in the first place. The Fibonacci sequence goes 0, 1, 1, 2, 3, 5, 8, 13, 21. Each number is the sum of the 2 before it. Here's what's interesting. As the numbers grow larger, the ratio between consecutive numbers converges to approximately 0.618. That's the golden ratio, and it's the foundation of Fibonacci levels. One thing worth knowing, the 0.5 level, or 50%, isn't technically a Fibonacci ratio, but traders around the world have used it by convention for so long, and price reacts to it so often, that it's included alongside the others. There's a reason Fibonacci is especially popular in crypto. Crypto trades 24 hours a day with high volatility, which means clear support and resistance levels don't always form the way they do in stocks. In that environment, Fibonacci levels serve as a shared reference point that traders worldwide look to. In fact, after major Bitcoin rallies or sell-offs, you'll consistently see price reacting at the 0.618 and 0.5 levels on the retracement. Finally, a quick note on timeframes. We recommend using Fibonacci on the 15-minute, 1-hour, and 4-hour charts. The higher the time frame, the more reliable the levels. If you're just getting started, practice on the 1-hour or 4-hour chart first. Now, let's talk about the golden zone. 0.618 is the golden ratio, the level that traders around the world watch most closely. In an uptrend, price is most likely to find support and bounce from the 0.5 to 0.618 zone. In a downtrend, that same 0.5 to 0.618 zone is where price is most likely to face resistance and resume its drop. This zone is called the golden zone because so many traders are specifically waiting for price to reach this zone. Buying or selling pressure naturally clusters here, which makes the signals even more reliable. Strategy 1. Golden Zone Bounce. The first strategy is the golden zone bounce. When a pullback enters the golden zone in the direction of the trend, you wait for a bounce or rejection, then enter. Let's start with the long entry. Confirm the uptrend. If both highs and lows are making higher levels, you're in an uptrend. Draw Fibonacci from the swing low to the swing high. The starting point is 1, the ending point is 0. When price pulls back into the golden zone between 0.5 and 0.618, wait. There are 2 conditions for entry. First, a strong bullish candle with a long lower wick must appear. Second, the following candle must be a bullish engulfing candle, completely engulfing the prior bearish candle. Also, check volume. If volume is increasing as price enters the golden zone, it's a signal that real buying pressure is coming in. That makes the setup significantly more reliable. Once all conditions are confirmed, enter the long position. Set your stop loss below the low of the bullish engulfing candle that triggered your entry. Set your take profit target at the previous high, the Fibonacci 0 level. Before entering, always confirm that the distance to your take profit is at least twice the distance to your stop loss. For the short entry, apply the same logic in reverse. In a downtrend, draw Fibonacci from the swing high to the swing low. Wait for price to bounce up into the golden zone. Even if it breaks through 0.382, hold off until it reaches 0.618. Once you see a strong bearish candle with rising volume, enter the short position. Set your stop loss above the high of the entry candle, your take profit at the previous low, and confirm a risk-reward ratio of at least 2:1 before entering. Strategy 2. Retracement plus extension. The second strategy uses retracement to find your entry and extension levels to set your profit targets. Instead of using Fibonacci just for entries, this strategy lets you plan both your entry and your exit at the same time. To use this strategy, add the 1.272 and 1.618 levels in your Fibonacci settings. Make sure to enter them as negative values, -0.272 and -0.618, so they display in the correct position on your chart. Let's start with a long entry. In an uptrend, draw Fibonacci from the swing low to the swing high. When price pulls back into the golden zone between 0.5 and 0.618, wait. Just like in strategy 1, confirm a bullish engulfing candle with rising volume before entering the long. Set your stop loss below the low of the entry candle. Take your first profit at the 127.2% extension level by selling half your position, then close the remainder at the 161.8% extension level. For the short entry, apply the same logic in reverse. In a downtrend, wait for price to bounce into the golden zone, confirm the entry, and set your stop loss above the high of the entry candle. Take profit targets are the same as the long. Close half at 127.2% and the rest at 161.8%. Before entering, always confirm that the distance to your first take profit is at least twice your stop loss distance. Strategy 3. Multi-confirmation trade, 4-factor confluence. The third strategy is a step up in difficulty, but it produces the most powerful entry signals. The reliability is far higher than when you're using Fibonacci alone. The core principle is simple. The more technical analysis factors that converge at the same level, the more buyers or sellers are waiting at that zone, and the stronger the signal becomes. You're looking for 4 factors to line up at the same time. First, support and resistance. Confirm that a previous resistance level has flipped to support after being broken. Second, the trend line. Check whether the trend line connecting the swing lows of the uptrend is also supporting the same area. Third, candle pattern. Look for a strong reversal candle, such as a bullish engulfing. Fourth, the Fibonacci golden zone. Confirm that this area overlaps with the 0.5 to 0.618 zone. When all 4 factors align at the same level, that's your entry. Also confirm volume. If volume is genuinely increasing at this level, it means a large number of market participants are all watching the same zone. Let's go through the long entry first. Set your stop loss below the low of the entry candle. Take your first profit when price reaches the previous resistance zone. Sell half your position there. Then close the remaining position when price reaches the prior high, the Fibonacci 0 level. Before entering, confirm that the distance to your first take profit is at least twice your stop loss distance. Now for the short entry. In a downtrend, check for the same 4 factors using the same approach. For support and resistance, look for a level where previous support has flipped to resistance after breaking down. For the trend line, check whether the line connecting the swing highs of the downtrend is also acting as resistance at the same level. For candle pattern, look for a strong bearish reversal candle, such as a bearish engulfing. For the Fibonacci golden zone, same as before, confirm it overlaps with the 0.5 to 0.618 zone. When all 4 align and volume confirms, enter the short. Set your stop loss above the high of the entry candle. Take your first profit when price reaches the previous support zone. Sell half your position. Close the remaining position when price reaches the prior low, the Fibonacci 0 level. Today, we covered 3 strategies: the golden zone bounce, the retracement and extension combination, and the 4-factor multi-confirmation trade. Different strategies, but one shared rule. Never enter the moment price touches a level. Always wait for candle confirmation and volume before getting in. Stick to this one rule and you'll cut out a lot of unnecessary stop losses. If you'd like to receive more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If you found this video helpful, please like and subscribe. Your feedback goes a long way in helping us create better content.